Welcome to the Key Controls Matrix and Delegation of Authority for Integrated Water Services and Affiliated Companies training. This training will last around 20 minutes and will cover the basics on the Key Controls Matrix and the Delegation of Authority documents. It is important that you pay attention to this training. As an employee, you are required to be familiar with and follow these controls and processes. At the end of the training, you will need to demonstrate your knowledge by passing a quick test. Thanks for your time, and we hope you find this course useful. The Key Controls Matrix is the document that defines the key controls and procedures within an organization. In other words, the controls that management has defined for the business and that are mandatory for all employees. The other document that we will cover in this training is the Delegation of Authority, which formally grants specific roles the power and responsibility to make decisions and take actions on behalf of the group. Before we go deep dive into these two documents, we will introduce the concept of controls and why they are important for any organization. Controls are mechanisms, policies, and procedures put in place to ensure the efficiency, effectiveness, and compliance of business processes. The purpose of controls is to mitigate risks, safeguard assets, maintain data integrity, and promote operational efficiency. More specifically, minimize risks and errors, help to safeguard assets and resources, enhance data integrity and reliability, and ensure regulatory compliance. In short, we need controls to build a strong foundation for effective business operations. The Key Controls Matrix covers U.S. Water Systems 3, which is the company that owns IWS, MMBR, Hyperion, and KLA. We will refer to them as the group. The Key Controls Matrix is divided into 5 areas. The first is the finance controls, which are in turn divided into 3 different towers. Order to cash, which covers sales and collections. Purchase to pay, which covers the purchase cycle, and record to report, which covers the production of financial information. The 4 remaining areas are compliance, operations, HR, and IT. The Delegation of Authority document has the same scope. Now some quick notes and ideas to consider on the Key Controls Matrix before we go into the detail. These controls are future-proof. Some of them cannot be enforced yet, as we do not have all the systems that can support them. As an example, we are required to raise purchase orders for all the purchases, however that would be supported by systems that are currently being rolled out. Compliance is normally ensured and monitored by an internal audit team, but we do not have one yet in the business. Hence, we will manage compliance by exception. When a breach is detected, it will be communicated to the executive leadership team, who then will discuss that breach with the employee or team involved. This is a live and evolving document, and you should expect it to change frequently as our business also evolves. All employees will have access to the latest version. Key changes will be communicated, and this training will be updated accordingly. The first finance tower covered by the Key Controls Matrix is order to cash. Order to cash is a business process that covers the entire order processing system. This cycle encompasses several steps including order capture, order fulfillment, invoicing the customer, and finally, collecting payment. The effectiveness of the order-to-cash process is crucial for maintaining healthy cash flow and ensuring customer satisfaction in any business. There are 10 key controls in the order-to-cash section of the Key Controls Matrix. The highlights are: only authorized employees can create new customers or alter customer details in the customer master data, or make any changes in the price master data. Before we do any work for a customer, we need to have a contract or other document, approved by our legal counsel, outlining the terms and conditions for the job or project. We need to invoice or send pay apps to our customers on a timely manner, and the invoices need to be accurate to ensure no revisions are needed. Credit notes should be rare, but when needed, they are approved as per the Delegation of Authority, and there is an analysis made to ensure lessons are learned, and the controls are enforced. Depending on the business and the type of project, there could be different revenue recognition methods. The ones we use are percentage of completion, deferral until completion, time and materials, and subscription. There is a process to ensure collections from customers are being monitored, and, when collections are delayed, there is a follow-up and escalation process. We need to define credit limits by customer, as well as keep and maintain an aged debt provision. We have a policy in place to calculate bad debt provision, and an approval process for accounts receivable write-offs. The second finance tower is purchase to pay, or procure to pay. This cycle includes several key steps, such as identifying the need and creating the request, sourcing the product and service by creating a purchase order, receiving the goods or services, processing the invoice in the system, and, at last, paying the invoice. Efficiently managing the purchase-to-pay process is crucial for optimizing operational efficiency, maintaining good vendor relationships, and controlling costs. Before describing the purchase-to-pay controls, it is worth to dedicate some time to discuss a key control in the purchase-to-pay area. The three-way match process in accounting and procurement is a method used to ensure that a payment is legitimate and accurate. This process involves matching three key documents: the purchase order, the receiving report, and the invoice. A purchase order is the initial document generated by the buyer, specifying the types and quantities of products or services they want to purchase, along with the agreed prices. The receiving document is created to confirm what was received, and details the actual quantities and condition of the items delivered. The third element is the invoice, issued by the seller to the buyer, containing details about the products or services delivered, including quantities and prices. The three-way match process involves comparing these three documents to ensure that the quantities and prices on the invoice match those on the purchase order and the receiving report. This process helps to prevent errors or fraud, ensuring that organizations only pay for goods or services that were ordered and received. It's a key control in the accounts payable process to ensure the accuracy and validity of financial transactions. With the three-way match explained, let's continue with the rest of the purchase-to-pay controls. There are 10 controls in the purchase-to-pay section of the key controls matrix, summarized as follows. Only authorized employees can create new vendors or change vendor details in the vendor master data. When possible, there should be a vendor assessment and selection process with at least 3 competitive quotes to ensure that we obtain the most competitive conditions. There is a process in place to vet and assess any vendors before they are included in the preferred vendor list. We create purchase orders for all our purchasing transactions, and we have a three-way match process in place. Our standard payment terms are either pay when paid, which means we pay our vendors the invoices related to a project and period when we have been paid by our clients. Or, alternatively, if payment terms are defined in days, our standard is 60 days from invoice date or more. Any different payment terms with vendors, including paying in advance, need to be approved as per the delegation of authority. The accounting team will have payment run controls to determine which invoices meet the specific criteria for payment. This step ensures that only eligible invoices are considered for the payment process. We do not pay any subcontractor before we have been paid by the customer, and if there is an exception, it has been approved at the proper level as per the delegation of authority. There is a defined travel and expenses policy for all employees in the business. There are adequate controls in the payroll process to ensure payroll calculations are accurate for wages, taxes, and other deductions, and those are aligned with legal requirements. Next section of the key controls matrix is compliance controls. Our group require all employees to adhere to the group code of conduct. Compliance controls provide guidance on what to do in the following situations. When an employee suspects fraudulent activities in the organization. How to handle and escalate customer complaints. How to notify and escalate any situation that can lead to a litigation risk, to ensure the legal risk is adequately managed. The other 2 main controls are around charitable donations, that can only be approved by the CEO and Board of Directors, as well as the requirement that any entertainment and hospitality for third parties follow the guidance contained in the Code of Conduct. The next section of the key controls matrix focus on operational controls, of which there is a total of 15, which we will summarize now. We require a purchase order or a contract from customers before doing any work or purchasing any materials or equipment for them, and the terms are always approved by our internal legal counsel. There is a clearly defined process for bids and tenders that outlines the templates to be used as well as the escalation for approval, before making any commitment to a customer. All change orders need to be approved and the margin should be above the main project's margin. If a customer or a bid is lost, there is a process in place to communicate and review it, to analyze what went wrong and how to improve for future opportunities. When the group agrees to uncapped liabilities, mitigations proposed during the contract review process are implemented, monitored, and maintained. Subcontractors are qualified according to the business requirements or the scope of services provided, and there is appropriate segregation of duties applied to the selection and approval of all subcontractors. A system is in place to track all liens, ensuring that lien waivers are obtained from our vendors once payments to vendors are completed. We continue listing the operational controls. Timesheets must be submitted promptly and require approval from at least a superintendent level. The approval signifies that the hours reported are accurate and relate to business activities. The estimate at completion, EAC, is set using the project execution manual methodology and is approved by the executive leadership team as part of the bid review process. Any changes to the approved estimate at completion require executive leadership team approval to make sure any cost overruns are properly managed. In that sense, any additional costs overruns require CFO or VP Finance approval. Project contingencies are determined during budgeting, aligned with project risk, and require executive leadership team approval for release. The Senior Vice President of Field Operations and the CFO or VP Finance must approve all warranty work before acceptance. All bonds, tender or performance, need to be approved by the CFO. A business continuity plan, including crisis and disaster recovery procedures, is operational for all sites, covering all key processes and IT systems. The HR section of the Key Controls Matrix contains 14 controls that we can also summarize. The CEO and CFO approve overhead roles, while the CFO or VP Finance approves new operational roles above and beyond the approved budget for a project. Any employment changes, including pay rates and benefits, need approval from 2 levels above the employee plus the CFO or VP Finance and HR. HR, along with the CEO and CFO, approve salary increases outside the regular cycle, guided by current salary benchmarks. The CEO, CFO, HR, approve any redundancy and severance expenses, ensuring compliance with local laws. Regional vice presidents must approve all overtime, travel time, and per diems. We continue with the HR-related controls. Any deviations from the standard timesheet process for hourly employees require the CFO or VP Finance's approval. Changes or additions to master payroll data are reviewed and authorized by someone not involved in the initial proposal of these changes. Payments to subcontractors are processed through accounts payable, not payroll, except as required by law. New employees undergo thorough checks including identity, residency, work eligibility, career history, and, where relevant, criminal background. Hiring a family member as a full-time employee is approved by 2 management levels above the referring employee, with the CEO's approval required for family hiring within the same business area. A process is in place for departing employees that covers HR and managerial duties during the notice period, including exit interviews and the handling of final payments and company property. HR must notify IT to deactivate accounts of departing employees within 5 working days after notice is given or upon immediate termination. Internal opportunities, conversations about new roles with employees must have prior written consent from the employee's line manager and HR. Employee relocations, regional vice presidents approve interregional transfers, while the CEO approves relocations to different regions. HR system, all employees are entered into the group HR system, with employment-related documents available electronically. The last section of the Key Controls Matrix focus on IT controls, of which there are 23, and can be summarized as follows. All hardware and software used in the organization is officially approved, have valid licenses, receive regular updates and patches, and are supported throughout their life cycle to minimize security risks and maintain operational integrity. Vendor contracts must be approved by the appropriate organizational authority. These contracts typically include service-level agreements that outline the expected service standards and response times. Vendor performance should be regularly evaluated to ensure compliance with these standards. Disaster recovery plans are essential strategies that detail how to respond to and recover from disruptive incidents, such as natural disasters or cyber attacks. Having these plans in place ensures that the organization can quickly restore its operations with minimal impact. Regular and secure backup processes are crucial for data integrity and recovery. In addition, antivirus measures protect against malware and other security threats, both of which are critical components of a robust IT security program. Control over system access is managed through administration rights and role-based privileges, ensuring that employees can only access information necessary for their job functions, thereby securing sensitive data and systems from unauthorized use. Only authorized personnel should have physical or network access to servers, and measures should be in place to protect against unauthorized entry or cyber threats. Data within the organization should be classified according to its sensitivity and importance. Effective data management practices ensure that data is handled correctly throughout its life cycle, from creation to disposal, according to its classification. Until now, we have covered the key elements of the key controls matrix. On this last part of this training, we will cover the delegation of authority. As mentioned at the beginning of our training, the delegation of authority defines the levels of authority and decision-making within the organization, outlining who can approve decisions and, when relevant, up to which value. Our delegation of authority has defined 6 levels of authority that range from the board of directors, level 0, to the project managers, level 6. This is a summarized version of the delegation of authority. The full version is available on our intranet. The takeaway of this slide is that, the higher the impact a decision has on the organization, the higher is the approval required. As an example, in general, acquisitions and divestitures will require board of directors approval. Changes to the corporate governance and structure also will require board of directors approval in most of the cases. When it comes to employment matters, transactions will require different levels of approval depending on the situation. Hiring a new CEO will require board of directors approval, while hiring an incremental position for a field project will just require HR and VP finance approval. Some financial management decisions, like approving the annual budget, are reserved to the board of directors, while in order to approve operational expenditure, a regional manager has authority to approve up to $5,000. In short, most of the transactions require approval at a CFO or above level. In case of doubt, please contact accounting or the full delegation of authority document. The delegation of authority is a key element of any governance framework in an organization, and it has several advantages. Streamlines decision-making. By clearly defining who has the authority to make approvals or rejections, decision-making processes become more efficient. This clarity helps prevent bottlenecks, as everyone involved understands who needs to sign off, thereby speeding up the workflow and enabling the organization to act more swiftly on opportunities or issues. Improves accountability. When individuals are held responsible for their decisions, it cultivates a sense of ownership and encourages them to consider the implications of their choices more carefully. This responsibility ensures that decisions are made thoughtfully and that those making decisions are answerable for the outcomes, fostering a culture of responsibility. Reduces risk. Establishing strict protocols for decision-making helps to minimize the likelihood of decisions being made without proper authorization or due to a lack of information. This can protect the organization from potential financial losses, legal issues, or damage to its reputation that may arise from improper or ill-informed decisions. Thank you for dedicating your time and attention to our e-learning session on controls and delegation of authorities. We hope the insights shared have been useful for your understanding on what the group expects from you in terms of controls and approvals. If after this training or reviewing the detailed materials you have questions or concerns, please don't hesitate to contact the accounting team. We invite you to complete a questionnaire designed to confirm your understanding of the materials. Your participation is greatly appreciated and instrumental in enhancing our training effectiveness. Thanks for your time.